Now we're talking about gold revaluation. To your point, the Fed can revalue its gold certificates to market today, or it could, to your point, have the Treasury and the Fed offer a bid to market at a higher price than spot and make a new floor in gold. If I were at the Treasury Department right now and gold's at 4,000, I could revalue gold today, our certificates at gold today, and buy a little bit of time, get $1 trillion plus in gold, and basically QE gold, use that revaluation to get some money to buy some U.S. Treasuries, take $1 trillion off the table. But why not wait till gold's at 8,000 or 10,000? You don't have to revalue gold at a new floor of 10,000 or even 20,000. It'll get there on its own, and then you can revalue your certificates then. I think they're just going to wait until gold's at a higher valuation.
Financial strategist Matthew Piepenburg outlines a scenario that could redefine the global monetary system: a formal revaluation of gold by the U.S. Treasury and the Federal Reserve. He explains that Washington could QE gold, using a higher gold price as collateral to strengthen its balance sheet and buy time amid mounting debt pressures. By simply revaluing its gold certificates to market, say at $4,000 per ounce, the U.S. could instantly unlock over $1 trillion in liquidity. But Piepenburg believes policymakers will likely wait until gold reaches $8,000 to $10,000 or even $20,000, allowing the market itself to force the reset. Such a move would mark not just a revaluation of gold, but a reassessment of trust in fiat money itself. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I mean, it's fascinating to me. But again, people think that maybe this is the end of the bull run. I have my bias. This is chapter 1 of a very long novel, maybe chapter 2 for the direction of gold. And it's easy to get seduced by certain headlines. I mean, even during Weimar, when you started to see wheelbarrows of money, every now and then there'd be a headline saying, the Versailles Treaty has been amended, our reparations are going to go down. And people would actually start selling gold and buying more Reichsmark. Within the next 2 or 3 weeks, the currency was getting slashed by 200-300% or doubling every 2 weeks. They thought that the problems are over. The problems that gold is an anti-fiat solution to, the problems that gold is solving or basically doing nothing but hold its value while the rest of the world devalues, those are not going away just because there's a $150 move in the gold price during this particular day, up or down. These problems are so endemic to the global macro system and the global financial system. Again, long answer to a short question, Elijah, but no, these price moves don't faze me because I hold gold for decades, not for weeks or months. I don't trade them. I save in them. The 1,000+ clients that we have from 90 different countries are doing the same thing. And any gold investor right now understands this perfectly. It doesn't faze me in the slightest, Elijah. It's a short answer. Now we're talking about gold revaluation. To your point, the Fed can revalue its gold certificates to market today, or it could, to your point, have the Treasury and the Fed offer a bid to market at a higher price than spot and make a new floor in gold. I think there's a number of reasons why that's inevitable. I know that the head of the Bank of America said it's inevitable. The question is, inevitable doesn't mean we can time it. If I were at the Treasury Department right now and gold's at 4,000, I could revalue gold today, our certificates at gold today, and buy a little bit of time, get $1 trillion plus in gold, and basically QE gold, use that revaluation to get some money to buy some U.S. Treasuries, take $1 trillion off the table. But why not wait till gold's at 8,000 or 10,000? You don't have to revalue gold at a new floor of 10,000 or even 20,000. It'll get there on its own, and then you can revalue your certificates then. I think they're just going to wait until gold's at a higher valuation. There's actually, ironically, a vested interest for the U.S. Treasury Department to see gold run, to let gold run, because when it's at a higher valuation, that's when they're going to decide to hit the button and revalue their certificates. They're based at $42 right now. So those 260 million ounces will have a lot more value revalued at 10,000 or 20,000 or higher than they will at 4,000, 5,000, or 6,000. And I think they know that gold can go that high. Many say that's pie in the sky thinking. When we saw Bitcoin go from 10,000 to over 100,000, that wasn't shocking because no one took it seriously. If gold went from 10,000 to 100,000, that would be scary because the world's stacking gold, the central banks are stacking gold, and he who has the most gold wins. It's a longer conversation, but I think they're going to wait until gold's at a higher valuation before they revalue gold because it's one and done. You don't want to do it at 4,000 or 5,000 if it's going to be 10 or 15,000. And eventually in our lifetimes, Elijah, I'm quite confident it will be. Not because gold gets shinier or because gold gets more headlines because there's more jewelry or wedding rings or dental fillings. It's because fiat money across the spectrum is just losing value versus gold because it can't be created ad nauseum like paper money can, and it holds its value better. And the fact that, unreported or misreported or malreported inflation is much, much higher than 10% or the 3% that we're saying it is now, that means that anything you're getting on a U.S. IOU from the short end of the curve, from a T-bill all the way to a 30-year U.S. Treasury, the yields you're getting on all those IOUs from Uncle Sam are completely negative returning because inflation is much higher than the actual yields on those bonds. That means you're getting a negative returning bond. As I've said many times, a negative returning bond from Uncle Sam is a defaulting bond, constructively a defaulting bond. So we're already constructively in default. The way we get around that is we just lie about the inflation rate. It's not even close to accurate, but it is the official rate, so that's the number we can measure our risk with, but it's absolutely fictional. So if you and I see that, if many of our listeners already see that, of course China, Russia, the BRICS, the other nations of the world see that, and that's why they're turning their back on the US dollar slowly, not overnight, but slowly but surely. And certainly since we weaponized the dollar in 2022, as I said then, the jig is up now for that. That was a watershed moment, as big a moment as 1971, because the world will no longer trust a weaponized neutral reserve asset. And that's why de-dollarization has gone so exponential. That's why the oil trade has gone off the petrodollar so fast, not completely, but it is a significant trend. And that's why central banks now hold more gold than U.S. Treasuries. Again, something unthinkable 5 or 10 years ago. It's all happening right now. History is actually happening right in front of us.
Matthew Piepenburg believes we are still in the early stages of a long-term monetary reset, not the end of gold's bull market. He argues that gold's rise isn't about speculation, but rather the inevitable decline of fiat currency credibility. Piepenburg anticipates an eventual revaluation of gold by the U.S. Treasury, in which the government will utilize its gold holdings to stabilize its collapsing balance sheet. But rather than doing it now at $4,000, he expects policymakers to wait until gold reaches $8,000 to $10,000, or even $20,000, maximizing the impact of that reset. This move, he says, would mark the moment when faith in fiat collapses and gold reclaims its role as the world's ultimate store of value. Let's get into the interview.
Well, it's a very important question. And of course, I can't just say, well, don't worry, gold and silver will only go secularly up and there's nothing to worry about, no major pullbacks. Yes, of course, there are pullbacks in bull markets. I still believe that. And I absolutely believe that the world in 2025 is very, very different than the world in 2011 for all the reasons we just went over. Again, from the BRICS, to the de-dollarization, to the tier 1 status, to even banks like Morgan Stanley recommending 20% gold allocations, to the obvious movement by central banks to prefer gold over U.S. Treasuries, Judy Shelton, et cetera. So the world in 2025 and that tipping point, that pendulum swing to real money versus fake currency or paper money is very, very on the minds and very conscious of the central banks and the policymakers of the world, much more so today, post-2022, than it was in 2011. So comparing gold and silver's moves in 2025 is very different than in 2011. So all the reasons I see gold in a bull market, silver will outperform gold in percentage moves, both to the upside and the downside, depending on the volatility. But in the long run, silver will be significantly higher in the future than it is today if you're holding it for the long term. But it's important. That's my view. That's my conviction. To those who would say Piepenburg is possibly selling his book, his dollar case is intelligent, but it might not necessarily be correct. These are important things. I want to make it very clear that there are cases where the dollar could have a last dance, as Henrik Zeberg said, or as in certainly the Brent Johnson, the milkshake theory, he thinks the DXY could go to 130. Could that mean a weaker gold and silver price? Could Matt Piepenburg's thesis about the macro environment in 2025 being so different now that maybe gold and silver are at some risk and his secular arguments are too optimistic? You got to at least look at that, right? I mean, again, I have said that devaluation is nothing new. I have said that the debt levels today are very different than 2011 or even 2008, and that the world is proving itself with its central bank stacking and with its preference for U.S. dollar or U.S. Treasuries. It's proving that this time is a very new cycle, not different. It's just a new part of the cycle, that it won't be behaving like prior pullbacks. And the strong dollar case by Henrik Zeberg in particular is that, look, Matt, you can say all these things you want about debt and how ugly the dollar is. Brent Johnson would agree how ugly the dollar is, but the DXY is going up because in times of real stress, that's still the safe haven. And they would argue that 58% of global FX reserves are in US dollars, that 80% of global trade finance is in US dollars, that 13 trillion plus in global debt is still denominated in US dollars. There's massive euro dollar demand. There's massive demand in the derivatives markets because they all have to be backed by U.S. Treasuries, and there's 90 trillion FX swaps, Matt. So look, when the what hits the fan, if markets mean revert, that means the world's going to still run to the best horse in the glue factory, the U.S. dollar, and the DXY is going to spike. And what Zeberg is saying is when that happens, there's going to be a run to the safe haven of the U.S. Treasury and the U.S. dollar. DXY will spike, and there'll be a 30% retracement in gold, which means a much higher retracement in silver. That's the case against what I'm saying. It is a valid case. You cannot ignore the case. My counter to that case is, first of all, running up into 2025 is very different than the run up into 2008. And the world is very much showing us their hand, so to speak. And that is, the world is already preparing for some type of mean reversion in the market, some type of credit crisis, some type of uh-oh moment in the S&P. It may or may not happen, but if it did, the life raft the world is already showing itself to go to is clearly precious metals and not the U.S. dollar or the U.S. Treasury. Again, if you look at Treasury auctions, if you look at the net dumping of U.S. Treasuries and the stacking of gold, if you look at what the BIS is doing, what the IMF is doing, if you look at what central banks are doing, if you look at the fact that, central banks now, as of this, again, recording, own more gold and hold more gold than U.S. Treasuries, that if Zeberg, for example, and many like him say, if the market crashes, that the world's going to go to U.S. Treasuries and the U.S. dollar as a safe haven. I would argue that that is not going to be the case because it's already not the case. The world's already turning its back on the U.S. 10-year, the U.S. 30-year, the U.S. Treasury, and stacking gold. So if there is a mean reversion uh-oh moment, as Zeberg predicts, and he could be right, in 2026, 2027, or tomorrow afternoon, that the world's not going to react the way it did in 2008 because they're going to go to gold more than U.S. Treasuries. And so you won't see a spike in the DXY and you won't see a 30% retracement in physical gold.
What's unfolding, as Matthew Piepenburg explains, is not the end of gold's bull run. It's only the beginning of a much larger monetary chapter. He sees gold as the ultimate hedge against systemic decay, a long-term store of value that outlasts paper markets and policy pivots. In his view, short-term pullbacks are distractions, not signals of weakness. The debt-soaked global system, the weaponization of the dollar, and the central bank's historic accumulation of gold all point toward an inevitable repricing of real money. While some argue the dollar may still have one last dance, Piepenburg believes the next crisis will prove otherwise. The world's faith is shifting toward tangible assets, not IOUs. The race for sound money has already begun. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.